As we enter the final quarter of the 2025 calendar year, the performance of platinum group metals, led by platinum, palladium and rhodium, continue to bask in the spotlight. With platinum trading around $1,400 an ounce and palladium at roughly $1,200 an ounce, investors are beginning to appreciate just how acute structural supply constraints have become across the PGM complex. In his latest commentary on the sector, industry expert Ed Stirk, head of research at the World Platinum Investment Council, recently told InvestorStream that when it comes to PGMs, the forward curve has gone into strong backwardation, a clear indicator that there is a shortage of metal.
If you look at the market and focusing on some of the kind of indicators of material availability, and in particular lease rates, so that's the cost of borrowing metal, and then also the shape of the forward curve in the London OTC market, you can see that we've got extremely elevated lease rates. The forward curve has gone into strong backwardation for platinum. Those are clear indicators that there is a shortage of metal in the market at the moment.
Despite platinum's 60% rise in 2025, the squeeze is far from resolved, and Stirk noted the price move thus far had not been sufficient to solve the metal shortage, with tightness persisting across physical markets.
For platinum, we saw the price begin to move higher from May, effectively commodity markets 101. If you've got a deficit of material, then the way to solve for that is for price to increase until new supply is attracted into the market or demand is priced out of the market.
The deficit is most pronounced in platinum, where dwindling above ground stocks are coinciding with persistent automotive demand and a rapidly emerging hydrogen economy. Earlier this month, the Financial Times reported more than $100 billion was now being committed to clean hydrogen projects worldwide, a development that Stirk believes will keep platinum at the heart of decarbonisation efforts.
From a PGM perspective, hydrogen is the metals that are needed are platinum and iridium predominantly. There is research that's ongoing in using palladium as an alternative in fuel cells and electrolyzers and so on. But for the most part, really where palladium's going to come into the story is in terms of replacing platinum in other industries, so particularly in catalytic converters for internal combustion engine vehicles, in order to free up platinum's availability for the hydrogen economy. So there are benefits for both of them, but in absolute terms, hydrogen is more of a story for platinum than it is for palladium.
Palladium's outlook is less straightforward. While consensus expects a surplus, it relies heavily on increased recycling rates, a risky assumption. And given the reciprocal relationship between the two metals, palladium remains closely tied to platinum's trajectory. For developers, the investment case is clear, but requires effective storytelling.
It's always on the developers to try and get investors enthused about funding their production plans. So ultimately it's about going out there, telling the story. And I think for PGMs, they're not necessarily, because they're quite complex metals, they're not necessarily the best understood by the investment community. So it's really about going out and educating people, which is what we try to do.
And no company is as acutely aware of the PGM opportunity than Southern Palladium. The budding developer is ticking boxes fast at its Bengwenyama PGM project in South Africa, a unique development story which has gone from strength to strength since the company listed back in 2022. Earlier this month, SPD kicked off a 10,000 metre drill program for its definitive feasibility study during the first half of 2026. 4 rigs already spinning, pulling a bulk UG2 sample for metallurgical test work and running geotechnical holes to lock in mine design. This campaign will also sharpen up Bengwenyama's maiden 6.29 million ounce reserve at 6.17 grams per tonne. And back in July, Southern Palladium unveiled an optimised pre-feasibility study that put the project's value at an NPV of $857 million with a 26% internal rate of return. The smart move, a staged build that slashes upfront capex by 38% to $279 million while still shaping up as a 30+ year Tier 1 PGM mine. Regulatory milestones are also stacking up. With environmental approvals now in hand and the objection period in the rearview mirror, the company is eyeing the mining right grant in the near term, the green light to move Bengwenyama from planning into development. With South African reserves depleting, demand from both traditional auto catalysts and hydrogen fuel cells accelerating, and supply unable to keep pace, the opportunity for new projects is building fast. And while platinum and palladium markets are running hot on supply deficits, Southern Palladium is de-risking at speed, armed with strong economics, rigs on site and permitting almost across the line. As one of the last greenfield development opportunities in the global home of PGMs, Bengwenyama is shaping up as one of the Bushveld's next big PGM plays. But as Stirk reminds us, in PGMs, as in mining more broadly, timing is everything. And right now, the clock is ticking.